I invested in that first bubble of 1968 and managed to make a small fortune and lose it. And after that, I became a completely die-hard value.
The stock market might be in for a colossal crash. Billionaire investor Jeremy Grantham is sounding the alarm, warning that the market is not just a bit overpriced, it's shockingly overpriced. He's even suggesting that we could be facing a 60% drop from current levels. If his prediction comes to pass, this crash could rival the devastation of the Great Depression. If anyone is to be trusted regarding market crashes, it is Grantham, and he has built a career and a massive fortune by accurately forecasting market crashes. He's warning everyone that the market is like a huge bubble that's about to burst, and it's bigger than any bubble he's ever seen before. The scariest part? He might just be right. Grantham explains his view on the stock market. Hopefully, we'll settle around 3,000 on the S&P if everything goes well and my additional concerns don't hit too hard. But if those concerns do hit hard, which is unfortunately quite likely, then we could see the market drop closer to 2,000 than 3,000. Let me remind you, the market hit 666 last time. So, even at 2,000, it's come a long way since 2009, hasn't it? Or maybe it'll split the difference and settle around 2,500. But I think it's safer to count on 3,000. So, the market may be significantly lower. Grantham's warning is clear. He believes there's a real chance that the S&P 500 could plummet, possibly even below 2,000. Investors should be prepared for a potential major downturn in the market. It is safe to say the economy is not looking good. There's a strong chance we're heading for a significant downturn. Profit margins are likely to shrink, and the road to recovery might be much longer than we'd hoped. Grantham's analysis of past bubbles paints a pretty grim picture. He's puzzled by how people can claim they never saw these crashes coming when the signs were so obvious. High price-to-earnings ratios in 1929, 1972, and 2000 were clear red flags. This time it's no exception. Despite being labeled as a perpetual pessimist, history shows that bubbles always burst. If we're likely, the S&P 500 might settle around 3,000 eventually. But brace yourself because the aftermath of such a burst could be long and painful, all too similar to Japan's stock market, which is yet to recover from its 1989 peak. The recovery in land and real estate prices has been sluggish, taking over 30 years and counting to reach their previous highs in nominal terms. This pronounced lag in reaching old high marks the longest and most painful recovery from a peak ever recorded. The symmetry of this recovery pattern mirrors the magnitude of the bubble it follows. The current bubble, which includes real estate and bonds, surpasses the 2000 bubble in size. Comparing the pain felt in the aftermath of the 2000 bubble burst, where the economy experienced a gentle recession with no real estate or debt issues, highlights the potential severity of the current situation. Back then, despite favorable conditions, the Nasdaq plummeted by 82%, with Amazon dropping by 92% and the S&P 500 by 50%. This time around, the setback is unlikely to be as gentle as in 2000, indicating that the market may be in for a tough ride. The S&P 500 is a market cap weighted index comprising the 500 largest publicly traded companies in the US. It's often used as a gauge for the overall US stock market. The denominator of the Shiller PE ratio is the average inflation-adjusted earnings of these companies over the past 10 years. This method helps to smooth out fluctuations in earnings that occur during different phases of the economic cycle. The Shiller PE ratio, dating back to 1871, is currently at nearly 39.89. Surprisingly, this figure is higher than the peak before the 1929 stock market crash, the one that triggered the Great Depression. During that crash, the stock market plummeted by 90% over 3 years. It took until 1954, a staggering 25 years later, for stocks to return to their pre-crash levels. As concerning as this comparison is, it only scratches the surface. Let me start with a simple explanation of the Shiller PE ratio before diving into the details. The Shiller PE ratio is a way to measure if the stock market is overvalued or undervalued. It's calculated by dividing a price of the stock market index, like the S&P 500, by the average earnings of the companies in that index over the past 10 years. Adjusted for inflation, this helps smooth out any short-term fluctuations in earnings that might distort the true value of the market. Let's delve deeper into how the Shiller PE ratio is calculated. In simpler terms, businesses have both good and bad years in terms of profitability. During strong economic periods, companies tend to earn more, while during economic downturns, profits decrease. By averaging earnings over 10 years, we get a more accurate picture of a company's typical profitability, accounting for both highs and lows. Adjusting for inflation is also crucial, as it ensures that earnings aren't artificially inflated due to changes in the value of money over time. In recent years, the United States has provided a clear example of how inflation can distort a company's profitability. When inflation and a company's profits both increase by 9% in a year, the apparent rise in profits is simply a result of everything costing more due to inflation. Instead of just looking at the earnings from the past year, which short-term factors can influence, the Shiller PE ratio takes the average inflation-adjusted earnings from the past decade. This helps us see through the ups and downs of the market and get a more stable view of its value. So, how do we calculate this ratio? Well, first we gather the annual earnings of all companies in the S&P 500 index for the past 10 years. Then we adjust each of these earning figures for inflation using the Consumer Price Index. Next, we calculate the average annual earnings for the entire 10-year period. And finally, we divide this average earnings figure by the current price of the S&P 500 index. By following these steps, we get a clearer picture of whether the market is overvalued or undervalued, helping us make more informed investment decisions. Grantham's stark warning about the stock market's true condition is as alarming as it is revealing. He argues that beneath the surface of record-high profits lies a looming threat, an inflated stock market bubble ready to burst. However, Grantham contends that these seemingly robust earnings are artificially inflated and unstable. If we were to adjust these earnings down by just 25% to a more realistic 110, the Shiller PE ratio would skyrocket to a staggering 45. This would mark the highest level in the history of the US stock market, painting a grim picture of an overheated market on the brink of collapse. Grantham's skepticism is rooted in this potential scenario, where the market's true value is obscured by inflated earnings, leading to a bubble that is destined to burst. Grantham's concern goes beyond the current Shiller PE ratio, which is already alarmingly high. He also points out that the corporate profits are at a level that are unsustainable by historical standards. He believes that sooner or later, this bubble will have to burst, as it always does eventually. This concentration of the stock market bubble in the US is precisely what Grantham is warning about. While Grantham's views are not universally accepted, with some labeling him as a perma-bear, his track record demands attention. As history shows, markets can surprise even the most seasoned investor. So, do you agree with him or not? It's wise to heed his words. Do you agree or disagree with Grantham? Let us know in the comments below. Also, hit the subscribe button for more engaging content like this. Until next time.